Well, so welcome to our High Rock weekly video. This is our new format. We're hoping that this will actually be a little bit more interesting and perhaps a bit more brief than our weekly webinars. But this is something that we want to do. We want to talk about a few important things that we think are relatively important as we go forward. I'm Scott Tomlinson, and my partner and colleague Paul Tepsich with us here today, and he is the founder of High Rock. So it's great to have him with us, and Paul is the key portfolio manager as well. So we just go through a minor administrative, as you all know, if you're a first time, or as you may not know, if you're a first time listener, we do have a website, and you can
highrockcapital.ca.
That's it, and you can go visit that. And on our first page, we have a couple of things that we think are worth looking at. Certainly, our voluntary code of conduct, the introduction to our High Rock private client webinar, and of course, access to this video. So that's our website. So please feel free to check in with our website from time to time as well, especially if you're a regular client. This is, for the most part, for clients, but of course we welcome other visitors to come and have a preview. Anyway, last week, big news, biggest news of the week. I think that's kind of what we want to cover. U.S. GDP, higher than expected, 3%, and we think, to a large degree, that this is got to be some focus. Certainly, we'll talk a little bit about what we think about that. On the screen, you'll see the chart. In the white are the quarter-to-quarter movements, and you can see there's a bit of volatility with those.
On an annualized basis.
On an annualized basis, yes, thank you. And we try to smooth it out with a moving average there that shows what the actual longer-term trend has been. So slightly above trend at the moment. Paul, any thoughts?
I think one thing that could be driving some of the upsurge, I guess, over the past quarter or two in the U.S. Could be a weak U.S. dollar. You know, it's been hit pretty hard the last 6 months. So that could be providing a bit of growth for the U.S. economy. But it's still, it's the average. I mean, you look at the 1 year average, it's kind of just clipping along at, 2.5-ish, or even lower?
Less, yeah, closer to like 2. Interesting, consumer spending was a big issue in the third quarter GDP growth. How do you feel that translates going forward? I mean, from our perspective, obviously, we want to look at things that are telling us what's coming down the road, as opposed to what is history. Of course, this is all history, but what do we see going forward here?
I think, part of two things, I guess. We look at hard data, and this would be considered hard data, and soft data, which would be consumer confidence and things like that. And one thing that's probably, soft data have been higher than hard data over the last year to date. But on the soft data, it might even be hard data, is housing prices in the U.S. are right back to where their former peak. And that's got to provide folks, same as in Canada, quite frankly, with a lot of confidence and cushion in their household finances. So, they probably go out and they lever up a little bit more, and they go and lease a new car, buy a new car, go on a trip, spend more money. So I think the housing market is affecting the consumer, for sure.
And again, the next thing we want to look at normally is how growth impacts inflation. To date, we've not really seen a surge in inflation with better growth in the global economy, for that matter. But specifically in the U.S. economy, we've got the U.S. Federal Reserve meeting tomorrow and making their announcement on interest rates. We don't expect to see any change.
Do they release on Wednesday?
They release on Wednesday.
Yeah. No, I can't imagine there's going to be any changes right now in the U.S. I mean, I think these central banks went through a period where over the last 4, 5, 6 months where they're talking about increasing interest rates, and they have to a certain degree, and pulling back on quantitative easing, i.e. bond buying. to try and shrink their balance sheets a little bit. But the bottom line is, I think, looking at inflation, I think central bankers are still scared spitless about deflation.
More
Yeah,
so
than inflation.
than inflation.
Yeah,
And that is how they're leaning for the most part.
I think.
And one of the theses we've used historically is also that, central bankers don't like volatility. They don't like market volatility because it takes confidence away from the general public,
Businesses
and consumers. And so they'll err to the side probably of not creating or allowing volatility to make any great comeback. Volatility may make a comeback on its own for other reasons, but the central banks will do what they can to try to minimize the impact of potential volatility.
Then they've done a great job
so far. Absolutely.
That's a whole video right there on low volatility.
Yeah,
it's incredible right now in the U.S.
And that'll be a good topic for another session.
Yeah.
But today, one of the things that we want to talk about, other than what's been happening with inflation, I mean, we've seen that total CPI in the U.S. is now above that 2% level, but the core personal consumer expenditure number that is the Fed's target for inflation is still well below the target.
Yeah,
so
like 1.3%.
Exactly. Now, some of that may have to do with the increase in the cost of energy over the last little while. So total CPI is a little higher than the core. What else do you see in there potentially?
Well, I think, you can look at a 10-year chart as we have on the screen, but you can go back even further, and inflation continues to drop, not to the point of deflation, but arguably over a period of time. If we put a moving average on that, you'd see effectively disinflation, which means inflation still seeing price increases, but at a decreasing rate. And I think that's what's going on. I think that's a secular change in the consumer and businesses and the economy. Yeah.
So inflation not being an issue does have an impact on the bond market.
Sure.
Especially longer-term bonds, because investors in longer-term bonds use the yield they receive as their protection from inflation. If inflation is relatively low, then investors don't demand the risk premium that they would build into a higher yielding situation.
So what does the yield curve do?
So what is the yield curve doing? We've got rates moving up in the front end. We've got inflation low. So investors are still buying bonds in the 30-year area.
Right.
And as a result, we're seeing a flattening of the yield curve.
Absolutely.
And what does that mean?
I think it means two things. A, investors aren't worried about inflation, number one. And number two, we always see, we probably don't have a chart on it today, but we always see the yield curve flatten when the Fed is hiking interest rates and just before a recession. So, investors who want protection for their portfolio, they can buy, you're not going to get protection through a 2-year bond, so you can buy it through a 30-year bond if you're not worried about inflation. And I think that's part of what we're seeing in this yield curve right now, flattening the way it has. Like, actually, if we look at the chart, you can see how flat it was just before the recession in 2008, which I think even just before that, at one point, it was negative.
Yeah.
What are we at now? About 130 basis points.
Yeah. But it was definitely down to at least, on this chart, you can see it's close to just 50 basis points. So we're probably only a couple of Fed rate increases away from the potential of recession.
Well, that plus the 30-year market, part of the market even just doing better than it has. So for sure.
Yep.
For sure.
So that takes us in essence to talk a little bit, and we may spend a little bit more time on our fixed income model today, just because we want to talk a little bit about what we do when and how we position ourselves in our fixed income model as a result of our expectations for where we think the yield curve is going. Yeah,
fixed income, we have some Government of Canada bonds to protect the portfolio across right now is like the 3-year, an old 10-year and a 30-year bond. So we have a bit more of a weight in the 30-year sector because of our view. And we have some investment grade bonds across the curve, and they trade in very high correlation to government bonds. They act much the same. We have some high yield bonds, and some rate reset prefs, which actually improve when rates go up, which has happened over the past year. But our positioning is largely, it hasn't changed much over the course of the year, save for the prefs, which added some value. It's awfully hard to add and buy value at these rates, but it might be the right thing to do.
Talk a little bit about what you look at when you think about something that we call duration, and just maybe to give our clients a bit of understanding about what duration actually is. So when we take the average of all of the bond positions that we have in the portfolio, we come up with an average length of time to maturity.
Right.
And that would be the average of the duration in the portfolio.
Yeah, close to duration. Duration's a complicated mathematical formula that we don't want to get into,
Right.
but effectively it's a length of maturity in each bond, and you can do it by weight in the portfolio. So right now we haven't really extended our duration in the fixed income portfolio. We were positioned for a yield curve flattening, which has happened and has helped our portfolios, our fixed income models. But we actually took off. I guess that was probably the last major shift we did was right around the election a year ago or so, and we took off some duration. So,
and then of course with the global equity model, and we've done very little with the global equity model recently. About 3 or 4 weeks ago, we actually added a little bit of the Canadian index, which has worked out nicely for us. Actually,
yeah, it was about 3 weeks ago.
And that was
and the thought process on that one, Scott, was just that, you know what, at the time Canada was the only G7, G20 developed country in the world whose stock market was down year to date. Now, and again, that goes back about a month, because today now we're up about 3.5–4%. But it was just, I think we've been hit so hard in the energy space, which is roughly 23% of our index. And in fact, and that can carry over, but let's finish with global equity. We really haven't done any other changes. We still think it's, especially the U.S. market, is reasonably expensive here.
Yeah.
And there was a piece of news today, too. The House of Reps, it sounds like they want to take the business tax cut and move it from day one to 20% over 5 years, which is nowhere near as good as the market was expecting. And the market's selling off a little bit on that today, and government bonds are improving, but we'll have to see what comes of this maybe in tonight's news.
Yeah.
But it's not a great sign if there's a lot of tax cuts built into this, and they're coming slower than the market thinks.
Right. And in which case, all of the positives that have been built, there's a lot of positives built into the current valuation of equities right now. I mean, we've talked about this endlessly for the last long time. And, we are seeing earnings coming out for the third quarter, but earnings are really only running at a rate of 4.5% on an annualized basis, annual growth. And the stock market has built in significantly for the next year at least, significantly bigger earnings growth. So right now we're being very cautious on our global equity positions.
In the tactical model, we over the past week we haven't done a lot. Although Friday I just had like a bit of an epiphany. Something I talked on BNN Wednesday morning about some of these energy, oil and gas bonds, oil bonds specifically in Canada, and the bonds have been rock solid, these high yield bonds, yet the stocks have been annihilated. Now we've got oil up over $54 a barrel. So I wrote a blog on it, there's a slide on it. So I just kind of had an epiphany and said, you know what, we've got to buy some of these stocks. So we added some on Friday. And there was actually a Barclays analyst put out a negative piece this morning on the stock, and I thought we could buy more in, but it traded up, which is good news, bad news. But we'll get more in and start building more of a position in that particular stock and one or two others. So I think we want to have more exposure to oil right now, and specifically these companies where we know the management team, we know the cash flows, and they're pretty beaten down. This stock in particular, I think we sold it at $4.15 when oil was at $40 a barrel, and I'm buying it back at $3.23 with oil at $54 a barrel. And they've taken costs out. So, what else have we done in tactical? I don't think we've done a whole bunch. That's kind of one key thing. I'm looking at one U.S. stock that maybe about a month away.
Okay.
Yeah.
So that's great. And for the most part, that's what we want to talk about today. And I do, especially for days that we do talk about performance, we want to remind everybody that historical performance, of course, is no guarantee of future performance. We do work very hard to try to get the best possible risk-adjusted performance. I think next week we'll talk a little bit about that risk relative to return, the return per unit of risk. We'll talk a little bit about that next week. So come back and if you want to hear us yammer about that. That's really it. This is a new format for us. We're wide open to feedback. We want you to let us know if there's anything specific that you want us to talk about on any given topic. More than happy to be able to be involved in doing that. But thanks for tuning in today, and on behalf of myself and Paul and Bianca, we'd like to say have a great rest of the week and great weekend. We'll be back next Tuesday.